Welcome back to Trading 360. It's time for our 360 round on all things tech. And for that, we bring in our panel. Quint Tatro, Managing Director, Jewel Financial, and Doug Astrop, Managing Partner, Exponential Investment Partners. Thank you both for being here. So, Quint, I was just going through your notes, and it certainly seems like you think some of the names in the FAANG trade are cheap here. Tell me a little bit about that.
Yeah, thanks for having me, Nicole. First of all, not only do I think they're cheap, but I think that from a trading or investing perspective, everything is baked in. I mean, look at Microsoft, for instance. The consensus estimate for Microsoft is that they're going to earn $2.29 a share. The whisper number on the street is below that, $2.25 a share. So Netflix is showing us today, yeah, they had good subscriber numbers, but their financials weren't great, but it's baked into the price. I mean, Microsoft's 32% off all-time highs. The stock has taken basically, everything into consideration. And with $105 billion in cash, pretty much, in my opinion, all they need to say is business is okay, and the stock's going to move higher. All of these stocks across the board, whether you look at Meta, Google, Facebook, or Netflix even, Microsoft, Amazon, Apple, they have so much negativity baked into their price. I think we're set up for a very surprise upside on the earnings season here.
Okay, well, that's a good, nice support for the tech trade. Doug, what are your thoughts here? I know your favorite, Alphabet, Google, but tell me about the group and what you like.
Good to see you again, Nicole. Well, I hate to be boring and totally agree with the previous assessment, but we really do. I mean, we feel the same way. There's so much negativity out there, and expectations are so low that there's a strong chance that we get a lot of upside surprises. And these stocks have just been obliterated. I mean, the NASDAQ lost a third of its value last year. The FAANG, which is a little offshoot of FAANG, was down 38%. And so we think that was a huge overreaction that's now set these stocks up to really outperform this year. And so far, in just a few weeks of the new year, they've done just that. But looking at Alphabet specifically, I mean, here's a stock that lost a third of its value last year, or 30%, and maybe EPS dropped maybe 9% last year or something. So huge overreaction. And all of these companies have great balance sheets, strong growth typically, great operating margins, great free cash flow, great return on invested capital. And now for the first time in a long time, they're trading at really reasonable, if not cheap, valuations.
And something that I'm sure you're both combing through the sheets, but Quint, you noted how the balance sheet, no debt for Meta, Google looks cheap. And my concern here is, Doug, you're saying this year, if you got into the NASDAQ mid-year last year, you really did not do well because it started to hit those lows in October and bounce around that level. So it went lower. It made new lows from there. We can't possibly time the market. So Quint, what are your three favorite tech names? Doesn't have to be FAANG. And what would you do with the timing to get into those names?
Yeah, so I'm a fan of our guest's Alphabet. That's probably my favorite here. Google or Alphabet has an incredible balance sheet, unbelievable numbers across the board, and now trading at a valuation that's very attractive. Meta, even though it's well off of its lows, is also very attractive in my opinion. And then I really throw in a smattering of other names out there, really in the semiconductor space. But I want to comment on one thing really quick, Nicole, and that is, let's not forget what took all these names down. What took all these names down was not economic. What took all these names down was higher interest rate. And when you factor in higher interest rate or a higher risk-free rate, and valuations out there are basically based upon a risk-free rate, then people all of a sudden just went out, hit a sell button, and sold growth across the board. The businesses haven't really changed all that much, but the valuation projections have. So as the year continued to unfold, the Fed just continued to raise rates. If that is now slowing, or even sort of maybe off the table in the near future, I think these companies are going to have a huge snapback, because in addition to that, they're not only doing that, they're also cutting costs. They're laying some people off. Margins are going to explode.
Yeah.
Profits are going to be up. These stocks are going higher.
Yeah, understood. I mean, we're still in a rising rate environment, but I guess we could say some of it has been baked in, and that there are some good longer term projections for these names. So Doug, what are your thoughts? I mean, we just had Netflix out. They surprised us, adding more subscribers than anticipated, right? 7.7 versus under 5 million. It was pretty, and they did miss on the earnings, but it was a wow moment. I mean, no one expected that. So what are your favorite names? I know you mentioned Google, Alphabet. Doug, what are your favorite names, and what kind of timing would you see getting into those names?
Yeah, we love Meta as well. We think it's dirt cheap, and every possible bad news is baked into that price. And then, the other one we've been looking at recently is Tesla. It's gotten really reasonably priced here, 25 times forward earnings, something like that. And this is a company that can grow at 30 to 40%. So we would probably nibble on that one. I wouldn't go all in because it's very volatile, but that's one you could nibble on for more speculative. And we just think this will be a good year for tech, and you probably want to get in sooner rather than later, because who knows if the Fed stops raising rates in 2 meetings, these things could really take off quickly.
Let's talk about earnings season. I mean, we're going to be watching Microsoft next week, without a doubt. GPT has been all the talk, software service. Your thoughts, Quint? What can we expect from Microsoft?
Yeah, again, I want to make it very clear. The consensus estimate is 2.29, and the Wall Street whisper number is 2.25. So expectations are not high. I think it's more about what they say. I think it's more about some of the metrics, as we've seen with Netflix. Netflix numbers were not great. I mean, I want to be very clear. They missed huge on EPS. Revenue was basically up 2%, but they had a 4% price increase. What they're doing is they're showing, hey, we're still adding subscribers. You thought we were going to be losing subscribers or really having slow subscriber growth. Business isn't all that bad. And what the stock is doing is it's showing you the reaction of people on the wrong side. So all of these businesses, sure, you might have some one-offs if all of a sudden Amazon comes out and says, hey, the cost pressures are still there. We're really struggling with the massive hiring that we did. That might be a one-off. But across the board, I think, again, as Doug mentioned, we're set up for some upside surprises here. And to get back to your first question, I apologize for not answering it sooner. I like Doug's idea. You nibble here. You maybe move out of some of the defensive names and start nibbling into the tech here.
Wonderful to see you both, Quint and Doug. Thank you for a good look at a lot of these tech names. Quint Tatro, Jewel Financial, Doug Astrop, Exponential Investment Partners. Thank you.